Welcome back to my channel. This is the part 2 video of reducing balance method. This video also had to be divided into two, so there will be a part 3 in which I'll be explaining the provision for depreciation account in word problems. This one focuses on the fixed asset account. So let's get started. So this is the question we'll be working with today. A company maintains its non-current assets at cost. A provision for depreciation account is used for each type of asset. Machinery is to be depreciated at the rate of 15% per annum, and fixtures at a rate of 5% per annum. Using the reducing balance method, depreciation on assets in existence at the end of each year, giving a full year's depreciation, even though the asset was bought part of the way through the year. The following transactions in assets have taken place: 1st January, machine and fixtures bought; 1st July, only fixtures bought; and then 2013, October, machinery bought, and December, fixtures bought. And the financial year end of the business is 31st December. You are to show the machinery account and the fixtures account, and the two separate provision for depreciation accounts. So let's start with our word problem question. So I just divided all the important points so it's easier for you to understand. Now, so in our previous table form, there was only one van. There was no other asset. For example, they bought a van as well as a machinery. There was only a van, and we calculated a depreciation for one asset. But in this question, there are two assets that the business bought. So the asset 1 is machinery, asset 2 is fixtures. So what I'm going to be doing, I'm going to be explaining how to find the asset account, meaning the fixtures account, and the provision for depreciation account for the fixtures. And the machinery will be your practice question, and I'll be giving the answers at the end of the video so that you can check if they're right. So in my previous video as well, I highlighted the keywords or underlined them. So over here, the important keywords in the question are: the machinery is to be depreciated at 15% per annum. This 15% is the depreciation percentage given to you to be using for you to use it in the reducing balance method and to find the depreciation for each year. And at the same time, they also gave the percentage for fixtures, which is 5%. They are giving different percentage, so you can just assume that maybe the machinery was to be used more often in the business for everyday work, and so that they're putting more percentage depreciation, meaning that the value for the machinery will decrease faster than the fixed soon. Why? Because if a business starts on 1st January, their end of the year is 31st December. So if they start on 1st July, their end of the year would be 30th June. So just keep this in mind, because when we'll be writing balance carried down, we also have to state the date before it. So we have to write this date. Now I just divided the question because I'm going to be doing the fixtures for you people. So I just wrote down all the fixtures one. I just removed the machinery, which is to be done by you. So 2012, 1st January, fixtures bought for 290. 1st July, bought fixtures for 620. And 2013, this is another year, there's a jump in the year, and 1st December, bought fixtures for 130. So now what is asked? You also have to be very attentive towards what's asked. Sometimes people just keep making the accounts, and at the end when they look at the question properly, they realize that it wasn't asked. So the first thing they're asking is the asset account. For us right now, it's the fixtures account. And the provision for depreciation. What is this, if you're wondering? Remember in our previous video, I explained that the provision for depreciation is basically the added up amount of depreciation. We're just going to keep adding the depreciation for these two, for 2012, and then for 2013 we'll have a separate depreciation for this. Now we're going to be moving on to making our first thing that's asked in the question, which is the asset account, meaning the fixtures account. So this account is basically the easiest one because all you have to do is write down these amounts, just copy them down like this, and we don't have to do much calculation here. So let's start. So before making the fixtures account, we should be knowing this. So this is basically the placement of whatever will be going here or here, debit side or credit side. So for any fixed asset account, the fixed asset, or for in this case, which is fixtures, will be debit, and the bank or cash, whatever means of payment we're giving, will be credited. Now why is it like that? Why is this debit and why is this credit? So over here we know that when an asset increases, it becomes debit, and when an asset decreases, it becomes credit. So the fixtures is our asset because we possess it and we bought it, so it's our property now. So is fixtures increasing for us or decreasing? This is the question. Now an easy way to remember is, if something increases, meaning that we are getting it, we are gaining, and if something decreases, meaning it means that we are losing something. So are we gaining or losing the fixtures? We bought it, so we are gaining it. If we were selling it, we would be losing it. So now the fixtures is gain, meaning asset is increasing, so debit. That is how this debit came to be. So are we gaining the money or we're losing it? So we bought the fixtures, right? So we had to pay money to get it. So our money is gone away from us. So we are losing the money. And when an asset decreases, this arrow basically represents losing it. So when an asset decreases, meaning that the bank is decreasing, it becomes credit. So here, this is how we got credit. Now hopefully you guys understood this, and we're going to move on to the fixtures account. This is the main explanation for whatever is being debit or credit here. Now another thing to remember is that in these entries that we are learning right now, whatever is debited becomes credited here, and whatever is credit here becomes debit here. Basically it inverses. So this is the debit side, this is the credit side. Now the fixtures is debit, so the fixtures account is what we are making, so we don't need to state it again. But the bank here is credit, so it will go into the debit side. Let's start making our account. So let's look at our first purchase, which was fixtures for $290, and on 1st January. So we write 1st January 2012 bank. We are assuming that it was bought by bank, so we write bank here, and simply we just copy the amount given here to here. So 290. So this is the simplest one of all the accounts, and the next year's. Now we are gonna check in 2012 were there any other purchases. So in 2012 there were 2 purchases. We noted this one down, now we have to do this one as well. So we write 1st July 2012 bank, and simply just write this amount down, 620. Now we're going to be keeping each year separate, so 2012 will be separate. We don't need to write 2013 right now as well. So let's just balance this year's account and add these two up, which will give us 910. So balance carried down is 910, and balance brought down is 910. Balance brought down, remember, is always on the heavier side. So this side had the most amount of numbers. This one was empty. So the balance brought down is always on the heavier side, and balance carried down is always on the opposite side of this. So we got everywhere we'll write 1910 because there was no other number here. Now what will be the date for balance carried down? Remember we discussed this date would be written for balance carried down. So let's just write 31st December 2012. This will be the date for balance carried down. And what will be the date for balance brought down is 1st January 2013. Balance carried down will be the next year's date. So we are done with these two. Moving on to 2013. Bought fixtures for 130. Same as we did before. Write down the date. 1st December 2013. I'm just writing the date from here. And then bank 130. Now we're gonna balance this again. There's no other fixtures bought in this year. There's only one, so we don't need to worry about another entry. And now we're just gonna add these two up, which is 1040. Simply just write down the balance carried down, which is 1040. 31st December 2013, and then balance brought down 1040. 1st January, the next year's date, remember, 2014. So this is our complete fixtures account. This is the easiest account, and we just simply wrote down the purchasing amount from here, just copied them down, added them up, and wrote the balance brought down and carried down. That's how simple it is. Thank you all for watching, and please subscribe. That really encourages me to make more videos for you.